All right, everybody, I'd like to introduce our next presentation here on the afternoon session at Planet MicroCap Showcase in Track 1. This is a fireside Q&A with Ryan Irvine from Keystone Financial, and his guest for this fireside Q&A is John Loftus from Envela. Enjoy.
So to start with, I'm going to talk to you a little bit about Keystone Financial, but just to give you an idea of where we came from. Keystone is a fully independent financial advisor. By independent, I mean our sole source of income is from our clients who are individual and institutional investors across Canada and now into the U.S. We don't accept any remuneration whatsoever for a buy, sell, and hold recommendation on a company. We were founded in 1998. So for 25 years, we've been conducting what we call GARP research, looking for growth at a reasonable price. We started in the small cap area, like I said, a couple decades ago. So we have a particular area of fondness in this area and an area of expertise. But we go right from the $50 million microcaps, profitable businesses. We've owned Alphabet and Microsoft for a number of years as well. We help our clients build simple 15 to 25 stock portfolios. Keystone's a fully independent financial advisor. We went through that. I'm going to talk about one of the companies that is in our coverage today, and we've just picked it up in coverage. So there's where you can find Keystone. This company is called Envela. It's a re-commerce business that is based on recycling and reselling of products through two distinct businesses. The first is the commercial segment. That focuses on consumer electronics, IT equipment, offering customers re-commerce solutions to commercial clients, including many of the Fortune 500 companies, and we'll talk about a few of those. The consumer segment, also the commercial, that was the commercial. The consumer is a completely separate business, really. It operates as a multi-channel retailer, offering a marketplace for pre-owned hard luxury goods and precious metals. Now, this is our coverage on the company. We have just picked it up really in November. I've invested in it. Our clients have invested in it. We like the business. Obviously, that's why. I'll tell you why. It ranks as the mid-level of our risk profile, has a fair value of around 9-10 right now. We like to set a conservative fair value and increase that over time. Currently trading around 630. I'm not sure if it's at that today, in that range, right? 169 million US. High conviction buy for us, and it's in our U.S. small cap coverage. Now, why do we like the business? Well, we like companies that continue to grow their revenues and earnings over time. You can see tremendous growth here, which is what we like to see. Revenues, EBITDA, and basic earnings per share. Now, if we move to, it's not just 1 year of growth in this business. If you look over the past 5 years, a strong track record of revenue growth and EPS growth. So they've taken the business. John has taken it from 2 cents per share in 2018 up to 52 cents on a normalized basis, in that range. So tremendous growth there. That's what we like to see. Now, our investment thesis, it's very simple on the business here. It's that strong revenue and EPS track record with growth without dilution, which is important to us. It's recession resistant. Typically, the business historically either maintains margins or profitability or does slightly better in a recession. They have a balance sheet for expansion. It's $17.17 million in cash in the bank as at the last quarter. It's basically on a net cash position. Organic growth we would expect, and inorganic growth. Both of the markets are typified by fragmentation, high fragmentation, and allow for a significant amount or potential acquisitions and regional expansion. So fair value right now, it trades at about 12.1 times trailing EPS. We apply a 14 times our 2024 expected earnings and get around $9.10. If the company continues to beat estimates going forward, we increase that fair value over time. So let's get to our chat here. Now, it's really the meat of the presentation. I'm going to have a fireside chat with John here. He's the CEO of Envela. How you doing, John? How's Vegas treating you?
Good so far. Enjoyed the flight in. It's nice weather. It's beautiful outside.
Yes,
what's not to like?
Yes, it is a beautiful city. Now, you're a big part of the intellectual capital behind steering the ship in Envela. Give the audience a brief background on yourself and how you came to Envela.
let's see here. Questions about myself. Those are the hardest ones for me to answer. Let's see here. Let's go back. High school, graduated high school, went to the University of Missouri. From there, I got a internship on the Chicago Mercantile Exchange and worked with a company called R.J. O'Brien. They're still around to this day. And after college, I would get a job with Shearson Lehman Brothers and got my Series 3. So I've kind of been commodities based for as long as I can remember. So after working in Chicago, I knew that I wanted to trade commodities in the pits. That was back in the old times where you had crazy people yelling and screaming at each other. It looked like a lot of fun for a 20-something-year-old kid. And so as soon as I had enough money, I left Shearson and went back to Chicago, started trading commodities. I was a bond trader on the floor of the Chicago Board of Trade. And then after a number of years, I transitioned out and started a business that was commodity-based. And we went from employee of 1 to hundreds. And I think when I left the company, we did about $3 billion top line in revenue. And while I was at that company, it was the first time I got to know Envela, what we call Envela today. And at some point they asked me, they said, "Hey, would you be the CEO of Envela?" And the people that know me, I'm not a very public person. So, you know, I just turned it down. And then, like Ryan, I just keep looking at things and thinking it over. And I noticed they had these NOLs on their balance sheet. And as an American, we don't like paying taxes. So that's kind of the dream. So I actually pivoted and took over the company mainly just for the NOLs. And through that, I only had eyes for maximizing the NOLs on the balance sheet. But I've really kind of come to love the company, and working at a public company, it's been fascinating. And I think when people look back on my career, they'll say that my time at Envela is probably the best. So that gives a little bit of.
Yeah. Well, I
talk a lot. So.
I do that too. When you're investing in a company, like I said, it's the intellectual capital behind the company. So we want to know about you. We're investing in you. So we want to know as much as we can. There's some things we don't need to know, but we want to know a lot about you. Yeah. And just as an aside, John controls around 71% of the shares of Envela, mostly through other companies. He doesn't receive a salary or stock-based compensation for his work at Envela. So we consider him aligned. Additionally, you pointed out that the company in 2017 has suspended all stock-based compensation. Instead, you're paying employees and encouraging them to invest and purchase the stock essentially in the open market. Correct? Yeah. I mean, it's not something we see the alignment as good as we see in this company very often. We look at a ton of companies. So it is one thing. It's a feather in your cap, is what we'd say. So we pump your tires a little there.
I appreciate that.
Yeah.
That's the way we like to run the business.
So you're a re-commerce business. That's essentially, it's the circular economy aiming to increase the lifespan of manufactured goods, thereby reducing waste, pollution for a cleaner environment.
Yeah.
Sounds great. You operate through the two primary businesses. Can you give a summary on each company, the commercial segment, the consumer segment, and if you could please talk about some of your major clients in the commercial segment and the customer profile for the consumer segment. That was about a 45-part question, so hopefully you can handle some.
No, I think I can keep up with that. So when you look at re-commerce business, it is really a business about acquisition of material. Everybody wants to talk about who you're selling to and what your channels are, but re-commerce is reverse thinking. Thus the re part. So if you don't have material to sell, you can't sell it. So it's about how you acquire stuff. So when we divide up our segments, we look at how we acquire stuff, and we have both commercial customers and then consumer customers, and thus we have commercial and consumer. The commercial business, works with large corporations on re-commerce and their programs. And this really kind of deals with, returns and goods that, just didn't make spec. And so some of these goods can be resold, some of them have to be recycled, some of them can be parted out. We work with companies like Microsoft, Walmart, Verizon, Tesla. That's to name a few. And then on the commercial side, we work with customers. We work with customers directly, and we feel like we provide a marketplace where you can come in if you have an item and see what it's worth, and we make an offer to tell you what we can to pay for it. So it's and when you're buying and selling used goods, it comes down to authentication is a big part of it. So you need the experts to kind of look at the item, tell them what it is, explain them to them what the market value is today, and what you can sell it for. So that's kind of our two segments there.
Excellent, thank you. Now, what do you think you do better than your competition in each market segment that creates kind of a competitive advantage for you, that allows you to gain market share, continue to grow at the clip that you have over the last 5 years? Now we say, what have you done for me lately? Can you continue to grow at that clip for the next 5 years? What do you think is your competitive advantage? What do you do well?
So going back to the first question, where are you from or whatever? As a small kid, my parents had an antique store. That's kind of re-commerce at the very basics from long ago. So I've kind of understood re-commerce ever since I was about able to do anything. So we go into the business. A lot of people don't understand. It's a business about acquiring stuff, and that's what we focus in on. So we make sure we have the experts. We make sure we come up with the solutions for the companies. It's a very fragmented business, but it's one where we seem to succeed because we deliver to the customers what they're looking for. We're bringing them answers on items, on what they want, and we can tell them, hey, that's just not worth anything in today's market. You might want to, hang on to that, or So we're bringing solutions to, major corporations and really information to the consumer market.
Can you break down your strategic growth initiatives in each segment? Let's talk about the commercial segment to start with, where you work with some of the, the large names that you talked about, the Microsofts of the world, the Teslas. How do you see your organic growth going there? And then you have been acquisitive. How do you believe you can, the environment is right now for acquisitions, but let's just start with your organic growth plans, potentially expanding regionally as well.
Yeah, so one of the big things when you look at Envela, it's really a small player in this big market. We are very much a regional player at best right now. Most of our business is, Texas-based. So we definitely have the potential to grow geographically. We have started to grow somewhat geographically, and we are seeing the same success as we roll that out across the United States. So we expect to become a bigger regional player and more of a national player as the time goes on. It really isn't a whole lot different for the commercial or the consumer segment. It's kind of different what we do, but generally we see potential of growing geographically for both businesses, and that's currently what we're focusing on. We do have a lot of people bringing us, companies because, we tend to be successful and say, hey, will you buy our business? It's got to make right sense. We're not just a company that goes out and buys businesses to puff up balance sheets or revenues. If the company makes sense, we'll buy it. Yeah, it's got to be accretive.
One of the more powerful things that we've seen when investing in other companies is being, like you were talking about, this strategy of, doing something really well in one market and then replicating that into another market. Like a company that comes to mind, Expel, that we've owned for about 5-6 years, has gone from the U.S. to Canada. to Europe and just been able to replicate that strategy beautifully in other markets. If you can continue to do that, that's how you have long-term growth. I'm going to follow up on the consumer sentiment or segment growth. You had an announcement out on April 6th that you plan to double Envela's retail business in the next 2 years. The goal is to kind of replicate, like I said, that success in Dallas and Charleston and open up its 4 stores, retail stores, by the end of the 3rd quarter of this year. So the first of those is planned in Phoenix. Are you prepared for this? I'm sure you are, and fully funded. And so that's, there's a couple questions there, but you're replicating your success in other markets, like we said. So you're fully funded to do this.
Yeah. So we're prepared. I flew out here today. I stopped in Phoenix, the Scottsdale area, and we were touring the site that we've already announced and a couple others that we hope to announce soon. So we are on top of it. We are ready to move. Last year, I don't think this is like any surprise to anybody. Last year, this is April. Last year about this time, I think everybody started feeling this. You can't hire anybody. Every company is looking to hire people, and we're no different. We kind of ran into that problem. And our business is about people. And so when you can't hire people, it made growth difficult. And I feel like for the past couple of years, it has kind of slowed our growth. We're talking about our growth being great. I'm like, this is kind of putsy along. We need to move it along. And but last year, about November timeframe, all of a sudden for us, I don't know about the rest of the country, we've just kind of seen an opening in those hiring markets. As everybody else is announcing layoffs, we're getting fine, excellent people, and so no, we're fully funded. We're ready to go. We're ready to rock. We hope to beat any rollouts that we already announced.
So I guess with these initiatives now in place, if we look back, say 3 to 5 years from now, we won't totally hold you to this. What type of ballpark annual revenue growth is Envela targeting over the next 3 to 5 years? What do you look for? Like, you had impressive growth over the past 5 years. You think you've been limited a little bit there. What are you targeting going forward? I mean, it's really all about what you do going forward.
Yeah. So, like I said on the last question, we really feel like we've been, walking around with our hands tied. We wanted to grow faster, but without people, you can't grow faster. We're launching initiatives in both segments of our company, and I have the luxury. I own an airplane, so when we flew into Arizona, I had it full of people. We had people from the commercial side looking at sites. They're looking at sites today for expansion with companies, and the other side of the business was looking at retail locations. So both sides are growing very fast, and we expect to grow very fast. We don't really give a whole lot of street guidance on how fast we're going to grow, but I tell our people we expect to blow out the numbers that you posted for the past couple of years.
Okay. While you expect operating profit to grow in 2023, you will be fully taxed. You talked about that, where past losses were covered with significant, or past profits were covered with significant and past losses. Now, you expect that what do you expect your tax rate to be in 2023? I think you know that. And you expect the growth in 2023. I think we're looking at it to be weighted towards the second half of the year. When will it lap the tax impact in terms of EPS at some point this year?
This is the sad part about America. At some point, you have to pay taxes. So we're faced with that fact this year. We'll run through our NOLs. We are going to grow fast. We do believe that we are going to be, positive on our EPS this year. It's going to be a little bit towards the second half of the year, but we got numbers coming out next Wednesday if anybody wants to check them out.
So now, In the current macro environment, you've kind of stated that you can do flat to better if we head into a recession. Just explain why that is that you can operate that way in an environment that could be, generally negative.
Well, first of all, I did have the luxury of walking around here in Las Vegas before coming into the Planet Micro. I don't know that anybody here heard about this recession you're talking about. It's Wednesday. People are spending money like crazy.
Talk about recession. It doesn't seem to be coming, right?
So, but we tend to be in a business where, people look for other ways to bring in extra income. So there is a natural ebb and flow. If you're thinking of a car, you're going to trade in your car every 3 to 5 or 6 years. But sometimes you got 2 or 3 cars, and if times get a little tough, you get rid of one of those cars. So we tend to see an influx of goods. And if you remember, our business is all about the influx of goods. So the faster the goods come in, the faster the line grows.
Good. Okay. Well, I'll close out my questions. I want to give the audience some more time to answer or ask some questions, or unless you want to answer some questions from us. But you can ask some questions right now of John. So anybody got a question? We would hope. Right there.
We have very little debt on our balance sheet, but we have more cash than we have debt. So our debt is financed at 3.1% interest, and our cash is earning close to 4.5% interest. So we're not really looking to pay it off at any time soon. But you'd have to look at our thing, because I'm really kind of thinking of this year's numbers. If we're talking about numbers from last year, they're a little dated, but probably about $8 million in cash, and we got about $20 million in cash and about $8 million in debt. So mostly like real estate debt.
Sounds right. So further questions? Okay. Well, if you're too shy to ask the questions now, I'm sure John will answer.
No, I will not.
No,
this is
never.
it.
This is it. This is your only chance. Please ask questions. I think the company is a good example of a management team that's aligned with shareholders. It's growth. It's a reasonable price. And, if John can produce the results that he did over the past 5 years, over the next 5 years, that's what we're looking for, and we'll hold you to that. As long as you can do that. The share price, should continue. I mean, the relative valuations look good on it right now too. So, these are the things we look for.
Well, I appreciate you inviting me to this fireside chat, and first one I've ever done. So
I think we're missing the fire, though.
I know. It's been nice.
I haven't seen the fire. So.
I went to one with Jerry Jones the other day, and he just talked. He didn't have the guy with the time in the back.
He just went on.
He just kept talking until he got tired.
Well, we're no Jerry Jones.
No, we're definitely not Jerry Jones.
Well, thank you very much for coming, everyone. Enjoy Vegas. And if you've got any more questions to John, I'm sure he may not answer them.